Hello and welcome to Section 2. In Section 2 we'll be talking about the Bitcoin price historically and how it affects many other coins on the market. We will be talking about Bitcoin market cycles and how to identify them, the circulating supply of cryptocurrencies, and some other things that might help you along the way. Throughout the life of Bitcoin, there have been many attempts to understand and ascertain the value of Bitcoin and how to model it. Many ways consist of stock-to-flow model, the stock-to-flow cross-asset model, Metcalfe's law, and many others, and we will be going into depth about them. We will also be talking about the Bitcoin Liquid Index and the Fibonacci sequence that you can use to understand what might happen in the future. This is the Bitcoin Liquid Index. It is the Bitcoin chart with the most price history on TradingView. It has a price resolution of 1 day. The second longest price chart is Bitstamp and has a price resolution of down to 1 minute, but only goes back to the end of 2011. Taking a look at this chart, you can see that there are many small cycles relating to the price of Bitcoin. Here we have one back in 2013, another one at the end of 2017, another one in 2019, and another one right now. But actually, there's another cycle that we can't quite see in this picture that we have to zoom in to find. If we zoom in to smaller and smaller price movements, we can see that there is in fact one very small cycle in 2011. To be able to see all these cycles together, we must go on to a logarithmic chart. The difference between a linear and a logarithmic chart is instead of counting on the price axis by 1, 2, 3, 4, 5, and so on, we go by 1, 10, 100, 1,000, 10,000. So as we move up the chart, the moves are more exponentially large. To toggle the logarithmic scale, we can click this log button at the bottom right of our chart. Now we can see basically every movement since the very start of Bitcoin. And we can also see a lot of similarities with each of these cycles. In every single cycle so far, we've had a very unpredictable blow-off top that results in this spike, as you can see. In the most recent cycle, there was no blow-off top. We had this sort of sideways diagonal movement, which doesn't seem to be the end of a cycle. So what is it exactly? Well, first, to answer this question, we need to understand what causes these cycles. We need to drive at the core of what makes Bitcoin scarce, and that's mining. In Section 1, we discussed the rewards for mining a block on the Bitcoin blockchain, and how, over time, the reward for mining a block on the blockchain has changed. What you're seeing is a schedule for the rewards of mining Bitcoin each block. As you can see, on May of 2020, the reward for mining a block was reduced to 6.25, half of 12.5. And in 2024, this will change to 3.125 Bitcoin per block. So since every time this occurs, the mining reward is cut in half, the flow of Bitcoin onto the network becomes less and less. So if we take these dates of the halvings and put them on the chart, we might be able to find a clue as to what's causing the cycles. Once we place the dates of the block reward halvings, things start to make a little bit more sense. Now let's use the Fibonacci retracement tool to find places in cycles where we've retraced to during the bull run. In 2013, we retraced 1.618 times the prior cycle, as you can see here. And this Fibonacci tool is on linear mode. You can use logarithmic Fibonacci's, but to stay accurate with the price data, I'll be using linear for this example. For 2017, we can use the prior cycle to find the 618. And as you can see, it was a very important spot to retrace to. Now in the prior two cycles, we always crash back down to the 1.618 extension of the one that came before it. Let's see where we are now. As you can see, we came basically exactly at this 618 extension level. Now this isn't to say we couldn't go down further, but I would say that the bull run is far from over. If we were to say that the bull run were over, this would mark the shortest bull run to date. If we measure the first cycle from the creation of Bitcoin as a proof of concept cryptocurrency in 2009, it took us approximately 126 weeks to arrive at $32. After the next halving, it took us about 54 weeks. Or you could say it was 100 weeks or 110 weeks from the bottom. If we now measure the length of the 2017 bull run from the halving in 2016, we can see that the top was about 75 weeks, and as measured from the very bottom, it was 152 weeks, about 1,000 days. Now if we measure this cycle from the halving, this cycle would only have lasted 48 weeks. It would have been the smallest as measured from the halving. This is the original publication on the stock-to-flow model, published in 2019 during the bear market. This Dutch investor identified that the scarcity of Bitcoin, as determined by its block rewards, are similar to that of gold, silver, and other scarce commodities, because it can be quantified by its stock over its flow. This person pointed out that Satoshi Nakamoto compared it to gold, but as a digital utility rather than a metal used to conduct electricity or be smelted into goods. Bitcoin's use comes from its utility in transportation over a communications channel like the internet, rather than a physical transportation channel of physical space. The digital scarcity of Bitcoin surely has value because of the fact that it can be used so easily as contrasted to other scarce commodities. And the way that this is quantified is through stock and flow. Stock and flow are quantified as SF, stock divided by flow. As we can see, the stock to flow of Bitcoin constantly changes over time because the incoming flow is diminishing. This is different from silver, gold, palladium, platinum, diamonds, because the rate at which they're brought out from the ground can fluctuate, but it generally has a steady trend rather than the sharp change that comes as a result of Bitcoin's halving events. Here we can see a logarithmic power regression that shows the trajectory of change in SF as it approaches the SF levels of other things like silver and gold. As you can see, this oscillation around this power regression is quite tight. The simple power regression shows that the SF that changes over the mining cycles of Bitcoin do have an impact on its scarcity. It tends to oscillate over this power regression in the form of cycles where the price ebbs and flows. The conclusion of this publication is that the value of Bitcoin is highly correlated to its stock-to-flow ratio, in a similar way that silver and gold are highly correlated to their stock-to-flow ratio. He goes on to make another publication the next year in introducing a new way to model the scarcity and ultimately value of Bitcoin. The difference this makes at this stage of the cycle makes little difference to the medium-term price action, but rather it has implications down the road to when we're flirting with six-figure numbers. As you can see with these clusters, The monthly data oscillates between each one of them. This is caused by the mining cycle definitive date in the future that comes from the block number. When this was published, the next halving event was but a month away. As we can see from a much more recent update of this exact same model, the data shifted to the right after the halving and started moving on upwards to the next presumed cluster. This gives credence to the cross-asset model, but like I said, the difference between the stock-to-flow cross-asset model and the original stock-to-flow model is a difference of an average price well above what we're at right now. The original stock-to-flow has an average price for this cycle of 100,000. That is not the upper bounds, but it is in fact the presumed average during this time. This means that if we are to repeat any of the same behavior of previous cycles, this would place us well above this average price. If we are to presume that the conclusion of the stock-to-flow cross-asset model is correct, then the average price for this cycle would instead be around $260,000. Again, this would not be the upper bounds of our cycle, but rather the average in the incoming years. Essentially, the core difference between stock-to-flow and stock-to-flow cross-asset model is the removing of a standard time series model and instead a comparison with other assets like silver and gold. The latest stock-to-flow puts us at the very lower bounds of the model. This gives us a very similar message to our Fibonacci analysis earlier, that we're at a retracement of the bull trend, not at the end of the bull trend. Metcalfe's law is a method of valuing a network based on how many people are using it and the rate of its growth by the measure n squared, n being the number of connected users to the system. If we think back to what Satoshi Nakamoto said about Bitcoin, it is a payment system utilizing communications channel. Powered by the scarcity of its stock-to-flow, this makes it the perfect example of Metcalfe's law. Timothy Peterson, also known as N-Squared Crypto on Twitter, has compared Bitcoin to a virus in the past. He's used Metcalfe's law as a way to model the value of the Bitcoin network. Although he hasn't used the stock-to-flow figure as a consideration of the value of the network, he has used the network effect, which gives us a sort of lowest price forward trend using Metcalfe's law and the Gompertz adoption curve. Needless to say, I'm a big fan of Kane Island Digital Research. The golden ratio is an important figure in mathematics, numerology, markets, mass human psychology, and many aspects of chaos in nature. We can find the golden ratio by many means, but one you might be familiar with is by using the Fibonacci ratio. To find the golden ratio phi in the Fibonacci sequence, we need only find the ratio between two numbers in that data set. So by dividing 144 by 233, the number that comes after 144 in the Fibonacci sequence, we can find phi 1.618 in this sequence. You can do this with any two numbers in this sequence that are right next to each other, dividing forward or backwards. It is the absolute relationship between any two numbers in the sequence that follow or precede. If we take the square root of phi, we get 786, another Fibonacci ratio. If we square root 786, we get 886, another Fibonacci ratio. As you can see on the Bitcoin dominance, we've hit a very pivotal moment. Not only are we holding 786 as resistance after being in free fall for months, but we've also bounced off of the 886 Fibonacci angle on a speed fan. This speed fan is constructed by taking the absolute low and the absolute high of this time period. This is likely due to the fact that we simply haven't stopped going down, and alts have been pumping left and right regardless of their fundamental value. It's pretty likely that if we do see another leg of this bull market, Bitcoin will be the first to feel it. That's not to say there's not more downside when it comes to the Bitcoin market dominance. In fact, I expect just that. I expect that later on we will see an all-time low for Bitcoin dominance, just like in 2017. But that's mere speculation at this point. Something else that must be taken into consideration when thinking about the market dominance of Bitcoin compared to altcoins is that all altcoins on exchanges are often denominated by Bitcoins, not always United States dollars. I think this will likely continue to be the case going forward, as Bitcoin still retains a large portion of market dominance compared to all other altcoins. In this final portion of section 2, we're going to quickly touch up on tokenomics of altcoins and how they work. Tokenomics can be an incredibly creative way to set yourself apart from the other altcoins in the crowd since there's so many. But at the same time, tokenomics can present a sort of gimmicky way to try to attract people and their money into an almost worthless cryptocurrency. As we can see with SafeMoon, the market structure is eerily similar to Dogecoin, but the tokenomic difference can't be overstated. Rather than an inflationary cryptocurrency with no max supply, you have a deflationary cryptocurrency that auto-burns itself over time. Regardless of this fundamental fact, the market structure is almost identical. An insane pump up to the upside, resulting in ridiculous gains, followed by a massive dump to the downside, wiping out about 70% of its value. The fact that SafeMoon is a deflationary cryptocurrency doesn't spare itself from the fact that it gets decimated during times of downtrend in Bitcoin. One question you have to ask yourself is, where are the coins that are getting burned? Are they owned by the creators? Does that mean it's a liability? Or are the coins being burned straight from your wallets, therefore making them more expensive, but ultimately you end up with less of them, making the entire process almost meaningless? An example of an auto-staking token is World Token, in which 3% of token transactions are given back to all token holders. Note that this does not increase or decrease the circulating supply, but rather it redistributes it in a decentralized manner. A great method of determining the value of a cryptocurrency is looking at its price action over time as it survives or doesn't survive market cycles in Bitcoin. What does the relationship look like between Bitcoin and your cryptocurrency of choice during these times? Does it recover? Does it come back stronger than before? Is the money coming from new investors driven to turn a profit or participate in a decentralized network and alternative means of payment or capital allocation? This concludes section 2, and we're actually going to have a section 3 related to decentralized finance and how to best utilize it to leverage risk-adjusted returns that make your money work for you.